Hi everyone, and welcome to this week's edition of Maqro Minutes, our weekly webinar. My name's Conrad Song, founder and managing director here at Maqro Capital, and I'll be looking to present this week's presentation, which we have a lot in store for you. So let's jump straight into things. So firstly, before we jump straight into things, just to provide our general disclaimer here. Look, everything that we discuss today is general advice in nature only, not personal advice. We do not take into consideration your personal circumstances. And so if you would like to take into consideration your personal circumstances, please speak to a financial planner, etc. We are just purely direct equities exposure and research. So now to jump straight into things, it's been a very interesting last week. If we focus on obviously one of the sort of big headlights, so members of Reddit group caused a number of heavily shorted US stocks, mainly GameStop or GME, to soar. Now that's caused a lot of short sellers in those stocks to lose billions. So GameStop rose by 400% for the week. Other hedge funds have also rushed, as you can appreciate, to cover some of those short positions that they've had on other businesses to avoid a similar fate to Melvin Capital. So Melvin Capital had the largest short position on GameStop and sustained a 53% loss in assets, otherwise $4.5 billion US dollars by Monday. So not a small decline for some of these hedge fund managers. The US and Aussie markets were down 3.3 and 2.8% respectively last week. And the volatility index, or the VIX, reached 3-month highs on the back of these sort of sudden market movements. And so for investors, it's a pretty interesting time where we also had just recently the RBA come out to expand their QE program to another 100 billion. That's obviously going to be quite strong as a catalyst for equity markets locally. And so given the fact that we have volatility increasing and some good news, what's really important right now is we focus on the reporting season. This is really what we're trying to sort of communicate to all of our clients and investors as soon as we can. And so please stay tuned for the businesses that we're going to be speaking about today. Pre-reporting season. So in the ASX 300, expect to grow its revenues this reporting season, but only 45% of those companies are expected to grow its earnings. So that shows a squeeze in margins across the markets, likely due to COVID impacts. Companies in the ASX 300 are also expected to grow its earnings by 26% this reporting season, so rebounding heavily since the last reporting season that we saw. IT, materials, healthcare, and consumer discretionary are all sectors that we expect to grow the most this reporting season. So keep an eye out on those sectors. If you don't have much of an allocation in them, try to get involved. We expect the recent commodity rally to provide a lot of upside for mining companies, especially those with large diversified sort of portfolios like FMG, Rio, BHP. Which are also expected to pay a very, very attractive dividend. We'll go into that very shortly. US fourth quarter 20 reporting season, which is ongoing now, it shows a general outperformance in the financials. So hopefully, all things held constant, which is really not the case. Australia is very different to the US. We might see very similar sort of tailwinds and recovery conditions. We also think there's upside for financial companies from improving impairment charges and loan deferrals. So definitely sort of concepts or thematics to be looking out for. Okay, so we're going to jump into the companies that we like. These are sort of our top picks for this reporting season, and they're not all purely for the sort of outperformance. Some of these are dividend plays, mainly the first one here, Rio, and also Fortescue, which I'll dive into in a moment. But Rio's revenue is expected to increase by 3%. Earnings per share is expected to grow by 16%, and dividends per share is expected to rise by 11%. I just want to take one moment here to sort of take a pause and say, when it comes to these numbers and the expectations, so these are analyst expectations. This is what kind of the market as a whole is expecting. You've also got the guidance that these businesses provide. There hasn't been much guidance set for a lot of companies, and that's going to be why this reporting season is going to be even more difficult to navigate through. A lot of the estimates that these analysts are expecting are based on a lot of assumptions because it's just very uncertain due to COVID, and so a lot of these businesses have been less transparent as they usually would. And so when you look at these reporting season results, the idea is to obviously try to position yourself into companies that you think are going to meet or exceed expectations. And if you think they're going to miss expectations, obviously be aware that you might experience a bit of downside. These movements can fluctuate from anywhere from 5, 10, 15, even 20, 30% on the day they report, depending on the company and how badly they miss or how well they outperform their results. Just please try to understand and have earmarked what the expectations are. So when these results come out, you can have a look, or when we communicate them to you, you can go, okay, this is how much they missed by. They were expecting 16% in EPS growth, and they only had 5%. Well, that's a big miss. So keep an eye out on these sort of key figures. The main ones are going to be obviously revolved around their earnings and dividends. Just to move on, given a dividend reduction last year due to holding a fairly conservative stance during COVID, there is more upside risk for Rio for the expected 11% rise in DPS. It is also expected to pay a $4.10 divvy, which is 3.6% yield excluding franking credits, or 5.2% yield including franking credits. So that's not too bad. Its quarter 4 production results released on the 19th of January 2021 were slightly ahead of expectations, both production and spot prices. And also Citibank is pretty optimistic on a potential special dividend in this reporting season as well. So again, like I said, this is very much a divvy play for us. The share price has experienced a sort of strong performance, from November, as you can see last year, up to sort of early this year, and we're sort of seeing a bit of a pullback now. But as far as an investment thematic, it's very much an income play for us. So that's a chart just for your reference. Okay, the next one we want to talk about is FMG. Again, this is a dividend play, and you guys are going to be pretty surprised with some of these numbers. So FMG's revenue is expected to rise by 45%. Earnings per share expected to increase by 50%. No half-year market estimates for DPS, but for FY21, its DPS is expected to grow by 45%. So the expected DPS of $2.50 Aussie dollars for FY21, that translates to a whopping 11.2% yield, excluding franking credits, or 16.1% yield, including franking credits. So very much, again, a divvy play here. We also saw FMG beating all estimates in its Q2 production results, released on the 28th of January 2021, production, spot prices, and costs. And so that also provides an opportunity for a better than expected dividend given its 50 to 80% dividend payout ratio policy it's currently on. And so to bring the chart up for FMG, again, kind of similar movements to Rio in the sense that it's had a pretty strong rally since November, and we're starting to see that peel off due to the commodity prices. But it is a position that we are very much excited about, not only because of the dividends, which, as you can see, is quite strong, but we do very much like where Twiggy is taking the business in terms of its future sort of focus on renewable energies. We think that's a massive pivot that someone's got to lead the way, and who better to do that than FMG with its sort of nimble business strategy, which we've seen throughout the years, has done very well for the company. Okay, so without further ado, moving on to the next one. APE. So strong sales momentum. So APE's revenue is expected to increase by 50% and earnings per share expected to rise by 49%. On the 27th of January 2021, APE upgraded its guidance substantially, increasing its expected underlying PBT of $209 million compared to its previous guidance of 195 to 205 million. Now, this provides a lot of room for outperformance this reporting season. Given the strength of earnings growth recently, we also, I guess that's likely due to the strong automotive sales momentum for cars and trucks. But this is something that we really quite like. You can see the momentum in the share price, obviously reflecting the momentum in sales that they've experienced. For investors who are looking to take advantage of this company, we would be looking to, I guess, obviously provide you with the insight that you want a bit of a peel back, just because the share price is highly elevated at this stage. So NEC, strong sales momentum as well. NEC's revenue is expected to stay flat from last year, while its EBITDA. So NEC, strong sales momentum as well. NEC's revenue is expected to stay flat from last year, while its EBITDA and EPS are expected to grow by 40% and 43% respectively. And in December, it provided a trading update that showed strong advertising revenues of 20%, which previously was 15%. And the momentum of recovery in ad revenue also does provide a potential upside catalyst for NEC's earnings this February. So we're quite excited about this one as well as an outperformer during these upcoming reports. Just to bring up the chart again, strong momentum as a result of the sales. Always try to look to pick the stock up at a cheaper price. I mean, that I have a client that's, and it's a fairly straightforward, saying, but if it's not a bargain, why buy it? And I guess when it comes to momentum-based investing, you're really the measure of what a bargain is relative to where the share price is and how aggressively it's accelerating. So again, we're seeing a pretty big uptick in the share price recently, even in just the start of this month. And so for investors who are looking to take advantage or are not involved in NSE just yet, look to try to find that support range, which you can kind of see a lot of the time. Technical analysis is fairly. Sometimes it's almost a self-fulfilling prophecy where it's like, well, people like round numbers. This is going to sound very straightforward, and you might think it's too basic, but $2.50, it's a round number. You can see that it's had sort of resistance previously close to that figure. It's broken above that. You might see it come back to those levels as a now new level of support. And psychologically, people do sort of gravitate to these round numbers. You'd be surprised how often technically these numbers have an emphasis on the share price. But have a look at sort of where you would be comfortable picking up. But at the same time, bear in mind, you might miss it too. And then you're going to have to sort of look at another new resistance and support levels that are much higher than what you were previously exploring. So that's just a little bit of feedback for those trying to catch that wave here. Okay, so looking ahead, Australian retail sales figures on Thursday are coming up, so that's the 4th of February. We also have US unemployment rate on Friday, the 5th of February. That's expected to be unchanged at 6.7%. And US CPI figures, which is essentially just the inflation rate, next week. That's coming out on the 10th of February. Really important things to look at as an investor who's serious about their portfolio. Even if you don't fully understand what these results mean for you, keep an eye out on there. And what you'll notice is, as you see these big data points, you'll start to get a feel of what companies and sectors move in the local markets as well. And as a result, naturally, you'll get a more, sort of natural feel of how these data figures affect individual companies too. And you'd be surprised at how much of this whole investing game is about that feel. A lot of people think it's you got this handbook and you follow each rule step by step, and all of a sudden you're Warren Buffett. It's really not like that. It's just like riding a bike. Eventually you want to do it sort of subconsciously, and you have your processes in place. It's all quite systematic. And for clients who are working with an advisor, obviously you can rely heavily on the fact that we will be translating a lot of this sort of institutional data, which is what it's mainly used by. All these fund managers, they heavily rely on this stuff, and then provide it to you in layman's terms, and you'll get a very strong understanding of how it's going to sort of play out. And also, you'll also get a grasp of, okay, well, it's not always that straightforward. Just because something happens in the US and the unemployment figure doesn't mean it's always going to result in this type of a move in the financial sector or whatever it might be. And it's like, for investors who understand and have been in the game for a long time, it's really about stacking the odds in your favor. And one of the best ways you can do that is to be informed, get a feel for the markets, be able to bounce those ideas off people like myself and the advisors who are living and breathing this stuff every day. We have a very strong passion about it. So please give us a call if you don't have that relationship set up and you want that communication from an advisor. We'd be very much excited to look to get more involved in communicating to you our research and advice. But yeah, just to wrap things up, the reporting season is very much the big focus for us. There's a lot of companies, like I mentioned, that we expect to outperform, mainly the ones that we've outlined. But in the same way, because there is that lack of guidance, because there are businesses that have struggled tremendously, that didn't provide an outlook, there are going to be some shockers. Now, in the same way that a company could rally 5, 10, 15, 20, 30% on the day it reports because it does so well, it can do the same thing on the downside. If you're a prudent investor that doesn't want to be buying a bunch of blue chips, tucking it away in the bottom drawers and saying, hey, look, that's, I'll be at the mercy of the markets. I think it's really important to at least be aware. Be aware of what's going on. Be aware of what the analyst and the company is expecting, and as a result, the other investors are expecting. And naturally, when you see that massive decline, at least if you're aware, you're going to have that discipline and conviction to hold on to your to your guns and go, okay, that's fine. I'm going to be able to weather this storm because I know this is because of COVID, or I know this is because of X, Y, Z. However, if the expectations were really high and they were supposed to do really good things and they miss, it's like, okay, well, what happened? Do I need to be looking to exit now? So it tells a different story. And the first thing, when it comes to trying to identify an action plan, is to really identify what it is that happened. And you can't do that if you don't know when these companies are reporting, what their expectations are. It's actually quite difficult to rummage through 10, 15, 30, 60 stocks sometimes where you're going, okay, I need to be monitoring all of these reports. It's a lot, and investing is a full-time gig. And so, for those of you who have made the decision to delegate some of that sort of work to us, make sure that you've got that information available. Keep in tune with these webinars. We're going to be covering a lot more of these as they happen. And obviously, like I said before, get in touch with an advisor, speak to him, speak to her, and say, hey, what should I be expecting with this portfolio? All right, guys, thanks for tuning in this week for our edition of Macro Minutes. We look forward to our next edition next week, Wednesday. Thank you very much.